Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Hi everyone, welcome to the first quarter 2020 market update. As you can see, I'm not in the studio, I'm at home. My wife and I have been here now for 3 weeks. When they initially called for people to stay home, we did that right away, and it's been quite an experience. Especially the social distancing, not being around people and that. So I've been doing a lot of what calls Zoom. Probably 4 weeks ago, a lot of people didn't even know what that was. Now, just about everybody does, don't they? And we've been trying to do that with family, just to have that FaceTime and everything else with the grandkids. So, first of all, I've been showing you this every quarter. It seemed like we were rapidly approaching 11 years that we've been in this bull market, right? Now, the definition of a bull market is when you haven't had a better than 20% correction last longer than 2 months. Now, we have not had this one last longer than 2 months yet, but I think it's the consensus of the most that it's dropped more than 20 and probably is going to stay below that for longer than 2 months. So some are calling this the end of that long bull run we had, which lasted 10 years, 11 months. It should have not have come as a surprise. As we took a very defensive posture, if you know, back in the fall last year, because we came off 3 quarters in a row of negative earnings growth. The fourth quarter, which was positive, was less than 1%. And we just didn't think it was sustainable. We rely very heavily on fundamentals, most particularly earnings, because the market typically trades at a multiple of those earnings. So when earnings are flat, and the market's going up, we just don't see it being that sustainable. So case in point, look at the historic percentiles of where the markets were. You can see 8 of the 11 sectors were very frothy, very, very high. This chart was interesting because this came out in the first week of January, and I pulled it because I was getting ready to use it for this first quarter. But there was 5 leading recession indicators that had already been triggered. All right, and this chart was basically showing that basically the median center point for all these indicators was predicting that there was probably going to be at the beginning of a recession, the middle of March. And as a matter of fact, they put March 14th in this, and then what happened? It couldn't have been more right on. Now, even though we maybe saw a pullback or a correction, we certainly didn't see coronavirus coming, did we? This was something that was very interesting. If you look at the 6 years leading up to 2020, 2014 through 2019, earnings growth was averaging 7.6%, sales 3.6%, but S&P 500 averaging almost 13%. Folks, that was just not going to be sustainable. You can't have earnings and sales being much lower than what the market's doing. Eventually, there was going to be some kind of a correction or pullback. And then this is a chart I showed you last quarter. That orange line being corporate earnings after tax, the blue line or purple line basically being the S&P 500. Look at that gap. Again, unsustainable. And the last time we had that kind of gap was during the last recession. This is just investors' negative free cash. You can see that orange line when it's up, it's negative. When it's in the green, down, it's positive. You can see, look how high it was getting with the market. So we were looking at everything bubble at that point. What's very interesting to me is that after this market crash that we just had, dropped 30% in just a 16-day period, 66% of people that are invested out there are doing nothing. They're making no adjustments at all. I talk about this a lot of times when I do the live events. I was always encouraging people to get with us ahead of time, because when we get into these times, people get paralyzed. They're afraid that if they make any adjustment, they're going to lock in their losses that they already incurred. What they don't understand is that if there's more losses to come, there's adjustments they should be making now. don't be that person that just does nothing. Okay. Now we have our clients already defensively postured. We are well ahead of this. But if you're that person out there that's got still got an account out there that's maybe in a 401k, maybe aggressively postured, and you're just doing nothing with it, I encourage you to at least give us a call and see what we might want to do to adjust that. These are just the major indexes. You can see 2018, S&P down, NASDAQ were down. 19, boom year. That's all we were hearing about how well things were doing. And then look at this first quarter of this year. S&P down 20% at the end of the quarter. Dow down 23%. This is just the S&P 500 the last 2 years. You can see, it was on its way up, and look at that drop at the end. Pretty much wiped out everything that was made the last 2 years. What's really interesting, and you look at this chart, is a 30% drop in 16 days. Folks, that can only be compared with the drop it had back in the stock market crash of the 29, right? It took 30 days. Folks, that's unprecedented. It's hard to believe that this coronavirus struck that much fear into people in such a quick amount of time. This is just 26 corrections we've had in the market since World War II. Most typically, when it's just a correction, it usually takes about an average of 4 months to come back. But folks, what this is not showing is that there's been 12 what we call bear markets, okay? Not just a correction, but we're entering bear territory. And in every one of those cases, the average comeback was 2 years. Okay, so if you want to be that person who wants to ride it all the way down and hit bottom and then wait for it to come back, you're looking at some time. But if you're that person that can be defensively postured, as I like to call it, keep your powder dry, not incur that down. Imagine what's on the upside when you come up on the other side. If it takes 2 years to come back from, let's say, a 50% low, that's doubling your money. So it's something you want to pay attention to. It's something you want to know. This is just the S&P 500 versus the VEU, which is basically everybody else globally. And you can see we're much more globally connected than we like to realize. I've been saying this for a number of quarters now. Globally, they were in a recession. Our economy looked like it was doing very well, but I said it eventually, because we are much more globally connected, that was going to have to reach our shores. And you can see their market's following just with ours right now. GDP growth, it's been running about 2.5% the last couple years. The first estimate for this quarter was 2.7 by the Feds, but they got all kind of disclaimers on this because they're not pricing anything in with this coronavirus right now. Estimates are that it's probably going to be negative for this quarter and probably going to be worse for the second quarter. Now, the definition of a recession is when you have 2 quarters in a row of negative GDP growth. I dare say, like I just said, first quarter, second quarter, we're going to have that. So for all practical purposes, we could very well be entering into a recession. One of the bright lights before this pandemic hit was unemployment was 69-year low. Right? I mean, that was a great thing. But what's scary right now is I think as of this recording, there were 6.6 million people that just filed for unemployment. Estimates are that could be as high as 30% before this is done. Folks, that's higher than it was in the 1929 crash. Very scary. And I might just say, one of the reasons I think the Feds, we're going to talk about that, the Feds are going to throw so much money at this is because with unemployment numbers like that, that's scary. Inflation rate. The Feds have a dual mandate. They want to keep unemployment low and they want to keep inflation in check, usually about 2%. And they were pretty much maintaining that. But then first week of March, they dropped it 0.5%. And then when this pandemic hit, they threw everything but the kitchen sink at this thing. They lowered the Fed rate down to 0, down to 0. They talked about pumping $700 billion into the market by buying up treasuries, but now they're talking $4 trillion before this is going to be done. And mind you, the government had their stimulus package of $2 trillion, so they've got to fund that as well. Estimates are, folks, that probably before this is done, it's going to be 10 trillion or more that this government's going to go into debt for. Now, remember that our debt was like, what, 23, 24 trillion? Can you imagine when this is done? It might be 33, 34 trillion dollars. And I want to talk about this, though. This is something that's unprecedented by the feds right now. I've been saying for the longest time, the bubble I thought that was going to burst, and still could burst, is corporate debt. I just want you to take a look at this. Since the last recession, you can see that blue line is the market, but that black line is corporate debt. So for all the quantitative easing programs that the Fed was doing by pumping money into the economy, got to the tune of almost $4.5 trillion before this pandemic. And look at corporate debt going up from $5 to $10 trillion. Basically, all that money they were pumping into the economy was basically going on corporate balance sheets because it was so cheap. And then what were a lot of corporations doing? Buying their own stock back, right? It wasn't necessarily going to capital expenditures and the like. And then you look at this chart, showing, the credit worthiness of that corporate debt. And the junk and triple B rated stuff was on the rise. It was almost better than half the debt is in that territory. I was saying that all we needed was some kind of an economic slowdown, and that bubble was going to burst. It's no wonder why the feds are going to be trying to pump a lot of money towards that. But here's what they did that's unprecedented. They're now, the feds have always bought their own treasuries, but they've never been buyers of securities. So now what they want to do is, so this bubble doesn't burst, they want to buy exchange traded funds in the corporate bond market. Think about that. Now that's exchange traded funds, those are what they call ETF. Why are they doing that? They're doing it because they know that with this shutdown in the economy and corporate debt being the way it is, that we were going to see default rates rise, and it would look very similar to what we had in the 2008 crash, where banks start tightening up credit, and then there's no flow of money. And then I showed you this last quarter. This is just debt, world debt that was just piling on. And now, with all the countries in the world trying to keep their economies afloat through this pandemic and throwing this debt, folks, I don't know what this is going to look like when we finally get through this pandemic, but it's something we're going to definitely want to pay high attention to. This is an interesting chart. You can see that blue line kind of going all the way through there. That's just GDP growth for more year after year GDP growth. You can see it was basically trending downward. If you look at the GDP growth, that lower line kind of just slowly growing. Yeah, it was growing, but not in leaps and bounds. But that orange line, that's basically all, the debt. And you can see that all that quantitative easing and money they were throwing at this to try to keep the economy afloat wasn't necessarily adding to our GDP growth. So again, something that was not going to be very sustainable. U.S. wages and salaries were not really rising at any significant rate. The feds were scratching their heads over this because, usually when you've had unemployment be so low, wages start to rise, right? But as I've indicated before in their prior quarterly updates, I think a lot of the reason it wasn't rising is because companies were finding ways to innovate through technology rather than go hire somebody and pay them more. Where this is going to go from here, who knows? The government in their stimulus package that they put out, if you notice, they were really going after the individual people, right? They wanted to make sure they got money in their hands. Well, there's a reason for that. This chart you can see since 1980, so this is 40 years, wages have really not kept up with it, or just barely kept up with inflation. But this is the one that should really wake people up. Look, this is the blue line is the bottom 90% of people and their wealth. You can see that in the last 35 years, it's been declining. That red line is the top 0.1%, which has been on the rise. You got 40%, they say, recent statistics show 40% of Americans out there right now have no savings at all. So you take away their job and you're going to have chaos at that level. So they have to put money into the hands of those people to keep them afloat right now. You're going to hear more about this. If anything was a major wake up call, it's been the situation with China, right? With the coronavirus, we need medical supplies, the pharmaceutical stuff, and people were unpleasantly surprised to find that a lot of these goods were made in China. And now we can't get them as quick as we want to. So I think that when this is all over, there's going to be some changes to that. But if you look at this chart, you can see China's wages have been steadily on the rise. They're no longer the place of real cheap labor, but they are the most efficient. Look at all these sectors that they're in and what a dominant player they are in every single one of those sectors. I dare say they're enjoying much more market share in a lot of those areas than they should. And if anything's going to wake us up after all this is simply that. We're going to have to make sure a lot of that is brought back here. Crude oil. Can you believe it? I remember seeing this around $100 a barrel, not that distant past, and now it's at $20 a barrel. If this stays at this level, folks, this could just totally wipe out the energy sector. Now, what we had the U.S. now, producing as much as it needs, so we were a net exporter of oil for the first time. It was a good thing. But with all this production happening and then a shutdown of all the economies, now we have this oversupply. They're literally talking about ships of oil sitting out there in the ocean, no place to go. And then to couple that with the fact that Saudis try to work out a deal with Russia to try to lower production so they keep the prices up there, and then Russia didn't want to play. So it's exasperated the issue. Now, as of this recording, I know the president was talking about this. He said he had a conversation with them, and they're going to start cutting back production, but we'll see. Now, this is obviously great for consumers because it's our prices at the gas pump are low, but it's going to decimate the whole energy sector if they don't do something about this. Look at this Exxon. Just year to date, look how much it's dropped. It literally dropped to less than half its value. Again, decimated. This is this CRB commodity index. It's just a basket of 19 commodities that we track. Now, this hit a historic low in April of 2016 and pretty much was, kind of remaining flat. But look at this recent drop, just crushed commodities. This is the U.S. dollar index. This is basically since 1973, they're tracking our currency with all the other major world currencies, and they baselined it at 100. And so ever since then, they've just been kind of keeping track of it. Right now, it's right around 100. So what's that saying is that the dollar is not necessarily being devalued right now. But folks, again, I got to say, with all this money that they're trillions of dollars now, like I said, could it possibly exceed 10 trillion before that's all done? How that cannot put downward pressure on the dollar would totally surprise me. Now, I talked all last year about gold and silver and how they're great assets to have when you enter into recessionary times. Now, I would never call for more than 5-10% in the area, but I thought they were at lows that only had to go up. Now, in that panic selling that we had, you'll notice that a lot of people were throwing the baby out with the bathwater, and gold took a little bit of a dip, but now on the rise. Now the spread or the ratio between gold and silver is much greater too. So I think silver has even more of an upside. But gold has typically been, once you enter into recessionary times, has been a place of safe haven. Again, dare say that you hold on to those. I wouldn't recommend more than 5-10%, but great hedges when we enter into recession. U.S. consumer sentiment was at all-time highs. I mean, I dare say that's what was really propping up the whole economy. Low unemployment, consumer sentiment was high. As you can see here shortly, small business sentiment was high. That was certainly a good thing. But I showed you this last quarter. That darker line is consumer sentiment, but that orange line was CEO sentiment. And look at the gap. Anytime there was ever a gap that big, usually a recession immediately followed, as you can see with those gray bars going down. So I shared that with you in the last quarter. It's almost like the consumers are the last ones to know, aren't they? And then again, small business sentiment was high. U.S. manufacturing, you can see that when this is above 50, it's in expansion mode. When it's below 50, it's in contraction. You can just see it just busted below 50. Manufacturing is coming to a slowdown. It's contracting, folks. Now, I want to talk about this JIT, or what's just-in-time inventory, because you're going to hear more about this. We also learned with this pandemic. A lot of companies in the past, they used to, like especially in manufacturing or as retail, they'd have these warehouses of inventory, right? So they had it available, and when they need it, they bring it in, and then they stock the storehouse again. Well, a lot of companies tried to get more efficient, so they did this what's called just-in-time inventory. So, in manufacturing, for example, they know ahead of time when they're going to need parts for manufacturing production. So they'll order it ahead of time so that it arrives just in time when they need it. Same thing on retail side. For example, Walmart, they know in their point of sale systems when products are leaving, they know how much they have in inventory, what the lead time is to order, so that right about the time they need it, they get it just in time. That all works very efficiently when the markets are doing very well and growth is there. But you shut that down, and you disrupt that supply chain, which sometimes can be 7 tiers deep. It's a major disruptor. And folks, that's what what this pandemic has done. It has totally made us aware of just how much, especially from a medical equipment standpoint, like those respirators, as whatever they call ventilators for the oxygen for the folks. All of a sudden, they got to ramp that up and look at the lag times, Ben, just to try to get that in place. But it's something you're going to hear more and more about. Non-manufacturing index, it's still in expansion mode, but we'll see with these recent economic activity. I fully expect that to go into contraction mode very quickly. S&P 500 PE ratio. Now, this is just the price of the stocks, over its earnings. Historically, the market is traded at about 17 times its earnings. It was actually a little bit higher, that you can see got up as high as like 24 times earnings. Now you got to understand, this is looking in a rearview mirror that the earnings the last 1 year. Now with this recent drop, it actually fell. Right now it's at historic levels, right? And some say, okay, hit a bottom. But remember, it's looking in a rearview mirror. It's looking at earnings over the last year. If you look at what forward earnings are going to be, earnings are going to plummet. So this is where I say I think it's going to get worse before it gets better. What we saw in that first correction or pullback was justified. I was fully expecting that one. But now people think we're hitting a bottom, and they're getting a false sense of security. And I'm telling you, when earnings reports start to come out, I think it's going to get worse before it gets better. I just want to show you this. A lot of what was happening is the corporations with all that money, they were buying their stock, right? Now, why did they do that? Well, when they buy their own stock, it even though their earnings have not changed, it bumps up their earnings per share because there's less stocks as a divider. So as a denominator. So companies are playing with their earnings per share. So it's kind of hard to really read that when you're looking at PE ratios. But this one, when you look at the price of the market to sales, because companies can't manipulate sales, you can see that it was getting very, very frothy coming up into before we ended up with this pandemic, more so than we even had back in 2000. Now, corporate profits, and you look at this last 10 years, this is what was supporting that bull run. They were definitely on the rise, but this is the Fed's forecast of future profits right now. You can see it's going to get less, and I'm not sure all of this pandemic is even priced into that. Where earnings go, the market will go. Remember that. This is the volatility index, or VIX, or what they call the fear gauge. Historically, when things are normal, it's running about 20. Now, what does this mean? It's basically a complicated algorithm for what they think the market's going to do, 20 to the good or 20% to the bad. That would be a VIX rate of 20. All right. You can see here, this is just for the first quarter, it spiked to very high levels. The fear, the panic was very, very high. To show you just how much that was, look at this. That red line is basically the VIX rate. The blue is the market. The last time it got this high was back at the last recession, that 08. So people were very fearful. Another thing you want to be highly paying attention to. If this market drops to levels I think it's going to do, let's just say it drops to half its value. If you've got some IRAs and you expect now we get to the end and this thing's going to come back up, this would be a tremendous time to start converting IRA to Roth IRA, right? Because I don't care what bracket you're in, even if you're that higher bracket. Let's say you're in a 30% bracket, and a market drops to half its value, and then and does eventually come back. That would have been a great move. So I think this is going to be also a great time to be doing some tax planning, especially if markets move lower. And if you're somebody that wants to take advantage of that, give us a call and see if we can't, what the plan might be for you. A lot of people don't recognize too that, that column to the left is a current tax law. That law, that's going to sunset unless they make it permanent. So when you get to January of 2026, it's going to go all the way back to the old rates, as you can see. And so we were already doing a lot of Roth conversions, taking advantage of that time frame now. But with this pandemic, it's just raised opportunity. Most bear markets have 3 stages to them, okay? The first stage is what I call panic selling, right? Well, clearly we saw that in that 2 weeks, the market dropped to 30%, right? And then it started to come back. We've entered now what I call the second stage of a bear market, and that is those people that are buying the dip, right? They think we've hit the bottom. They're going to buy the dip. How I know that's happening is because I'm getting those calls. Hey, Larry, I think airline stocks looking very cheap right now. Let's do that. And I'm not going to say this still wouldn't be a time to buy some of those. There's some stuff that's really cheap out there that you can buy. But people think it's hitting the bottom. And I dare say you'll see this kind of go back and forth for some time. But with the negative economic news that's going to continue to come out, you're going to see it actually move slower. When the herd is going this way, like I was watching them do last year, I knew we needed to be going the other way. The opposite is true when you enter the bottom of a bear market. It's going to feel like it's never, ever, ever going to come back, right? It's going to bottom out, and it feel like the wrong time to get in. But folks, it's going to be the best time to get in. If this market can drop to half its value, there is going to be so much opportunity on the other end of this that you're going to want to take advantage of. But you just got to know what to look for. So where do I find, as I'm gauging this, where do I find ourselves? Probably right there in the middle, buying the dip, taking profits is kind of where we're at right now. We're going to see it go back and forth for some time. Folks, I hope this was valuable information to you. Certainly through this whole pandemic, we're working remotely, but we're available. Service work has not stopped. Give us a call if you're having any concerns. Maybe you're somebody I know what the roadmap is going to be for you. We're available. We're available to talk to you and help you. So I just want to say one final thing for all of you that are out there having to deal with this coronavirus, this pandemic, and you're home. My prayers and thoughts go out to you because, this is tough. This has been hard. This is a tough transition. With that, I'll end. Hope to talk with you soon. Hope you found this valuable. Thank you.